So welcome everybody. I'm Daniel from Startup CPG. Today here with another Daniel. You get double Daniel today, and we're basically the reason we did this database is because what we saw is that early stage VCs are gone. Like the one, I don't know, the old model of like, I'm going to launch my brand and get a big VC check and go to the moon that we all kind of dreamed of, I think in like, late 2010s. A lot of those guys are gone. And if you do find them, they're going to screw you with some terrible valuation. And they just want to kind of bet on sure things at this point. So, I think also just with a lot of the issues that we see around diverse founders also just like they are not getting a lot of the VC money, unfortunately, and that's going to be something that we want to help with. But I think financing options, we want to make sure everybody understands what's out there, because financing it's an option, and I think it's one that can be more accessible. And especially these days, while you could explore these options and not give up big chunks of your company at low valuations and maybe try to like save it to give away another day where you get more money for it to grow your business. So I was really excited to partner with Daniel Taylor and Bags on this. So they helped us put together this database, which I didn't know anything about before because I've never done financing, but I was like, I know people are looking for these options, and the process to find them is terrible. You just have to like ask somebody or just post in our Slack and maybe someone gives you like an option or two. And so Daniel helped us to go through and build the most comprehensive list that's out there of all of the CPG financing providers who do this non-dilutive stuff that we could find. And we didn't want you to have to like ask each of them, what's your minimum, and have all of you ask what's your minimum. So together, we basically researched all of them. We list out their minimums in the spreadsheet and so much more. So maybe before I talk too much just about what it can do, Daniel, do you mind just introducing yourself? Tell us about Bags and maybe why
Absolutely.
you wanted to work on the database with us.
Absolutely. Well, Daniel, thank you for the opportunity, and thank you for everyone who's in attendance. We a little bit of background on myself. I've been a founder for the last 8 years. I built and sold an advertising company that primarily works within CPG brands in 2019, and then really set off to start Bags with the goal of trying to increase access to capital. And if we can increase access to capital, specifically within the CPG space, we can enable businesses to grow. Because in often cases, what we're finding is there's not an issue of lack of demand. There's often an issue of lack of supply and an issue of lack of capital in order to finance that supply. And naturally, as a byproduct of building these businesses, cash conversion cycle is the name of the game. We got to get that tight. We got to give you the opportunity not just to get products on shelves or increase your spend within D2C, but it's about selling products, about getting those products off the shelf. And it's really, really hard to do if all your dollars are sunk into inventory. And so we built Bags really, from the lens of we wanted to build a financial growth platform that enabled businesses to figure out how to use debt for the purposes of growth, and then really understand what it means to be loan ready, which we'll definitely dive into today and talk a little bit about, because a big, big part of that is understanding your core financials, having the documentation in order to have an effective and efficient process.
Let's get right into that. Before I share the screen and go into the database, can we just so Amy from the chat said, I'm interested to learn more from this because we're going to need funding soon, and I want to know what options are available besides investors. So put yourself in those shoes. Like, you're an early brand, you're going to start needing it. Like, okay, what do you do day one? Like, start understanding what's out there, like get ready for that. Like, what would you be doing in the shoes of an early founder?
We like to look at things in sort of a three-step process, right? One, understand what you need money for, right? Like what really is the use case? Do you need dollars for inventory? Do you need dollars for marketing? Do you need dollars to deal with seasonality? Do you need dollars for general operational growth? Do you have purchase orders? Do you not? And that really is sort of the driver behind. And then from there, what will those dollars unlock? Because I think the one thing that we try to make sure that every business starts to learn and understand is it's all about, especially from a debt financing perspective, take on debt when it gives you an opportunity to unlock revenue, right? Like we should be able to draw a line between increase in available credit and unlocking revenue. So that's the first piece. Like, what do you need money for, right? Based off of that, then it's gather all your documents, your core financials, like make sure that you've got the bundle in the packet, meaning you need your last 12 months P&L cleaned up. balance sheet cleaned up, put together a debt schedule. If you don't have one, we've got some templates. More than happy to share it with the broader group. And then really get it so that you've got all the dollars. And Amy, I'm seeing you're saying dollars for advertising, inventory, pre-fills. Yeah, so I'll get to that exact example shortly. Once you've got all your documents ready, then based off of use case, a really, really good thing to do would be to honestly start with the database, go through some of the lending options, and think through what those use of funds are and try to match that with, right? Like which lender would fit that, and ensure and check out and make sure you check it out. Check out the section that breaks down their typical business that they would lend to, what their minimum requirements are. And to be honest, most lenders are pretty hard step, like locked down when it comes to, hey, I will lend to a business that's doing a minimum $100,000. So it's not necessarily worth reaching out to that lender, but make sure that you're fit on that side. And so, yeah, 3-step process, understand what your goals are, prep your financials, go through and start diligencing certain lenders. And then of course you can always tap on bags and we'll be helpful as best as we can.
And can you just say a little bit more? You obviously know more than I ever will about this topic, about like how do you, if as an early founder, how do you look at trying to get an angel investor or VC investment or non-dilutive financing or any other options that are out there?
Of course. Yeah. So the way that we think about the best ways to grow businesses, we actually think in the form of least expensive to most expensive, right? Like revenue is the best way to grow your business. If there's an immediate opportunity to maximize revenue and drive more revenue, go do that, right? Next, least expensive is debt. We can talk about why that is. And then the most expensive is equity. But we think of raising equity capital as a really good thing for investing in long-term ROI elements of your business, right? So my co-founder always says, raising equity dollars or venture dollars to fund inventory is like selling your car to buy gas, right? Like those two things don't necessarily add up. And in today's market, less investors are willing to fund things like inventory and marketing. They want those dollars going towards R&D, product development, product design, personnel, things that will have a longer tail ROI on the growth of your business. That in turn, you really need to make that capital investment into. And then for everything else, from our perspective, should be funded via debt. And so, as you're starting to explore the landscape, the other thing to consider is from a timing perspective, right? Debt versus equity. Running an equity fundraise in the current market is at least a 4 to 6 month process. At least, right? So if your use of funds in need of capital is, hey, like I need to go and raise these funds within the next 2 months, and you're expecting an equity investor to swoop in, like it's probably not going to happen unless you spent the 3 months prior building those relationships, right? Because it's all about, from an equity fundraise perspective, building relationships before you need them, and then tapping on those relationships as you start to pick up growth, and in turn, then establishing the opportunity for them to potentially invest.
Okay, great. So I think that's good to understand. And, everybody should look at all the options out
100%.
there. And if you want to go the investor route, like you've got a great family friend, maybe who's an angel investor. And let's be honest, like you can probably get a better valuation from somebody like that than a kind of, Mr. Wonderful type Sharky VC out there. So, definitely understand all the options. I really like doing education on this financing area because I think it's very poorly understood and plays the kind of finance ninjas that I know who manage to fund businesses in this space for a long time where you don't understand how they do it. This is mainly the stuff that they're doing. So, okay. So just to summarize what you said basically like when you're talking about funding with revenue, you mean like getting revenue and using the money from that revenue then to pay off your
Correct.
bills, not okay.
To reinvest in the business. Exactly.
Differently than revenue financing, which we'll talk about.
Correct. Which we'll talk about. Absolutely. So and the logic there is that if there's an opportunity, right, like all of us as founders need to decide where we spend our time, right? So if there's an opportunity to secure one more retailer or sell X amount more products, right? Like I'd go tap on that door, drive that revenue, close that deal, versus as the first step. And then from there, go out and make sure that you're securing any types of financing or capital from a position of strength. There are a couple other ways that businesses have thought about funding that they've been successful. So typically from some things that we cover, it's not our expertise, but things that are worth mentioning. Grants, right? Grants are something that a lot of businesses look at today. The good thing about grants is like, who doesn't love free dollars? The bad thing about grants is that from a time intensive perspective, it does take time to fill out those applications. One, likelihood of success is decently low just as a byproduct of volume, but it doesn't mean you shouldn't potentially apply. You could be that perfect brand that's a perfect fit for that opportunity. So I do encourage people to check out grants, especially in the early days. And then the last one is sort of crowdfunding, right? Which is something that a lot of people look at. There's different types of crowdfunding. So you can give away equities. So an equity crowd fundraise where you're giving smaller percentage of your business away to a large pool of individuals or potential investors. Great way to sort of engage your community to make them owners. Then there's debt crowdfunding, similar construct, but you in turn pay it back. And then there's pre-sale, right? Like, certain platforms like a Kickfurther or others where you can go out and you can pre-sell products before they're made. The one thing about crowdfunding to think about and always note is crowdfunding is a full-time job, as is a lot of fundraising, but especially crowdfunding. You need to be very, very good at marketing, and it helps a lot if you have a pre-built community, right? Over 85% of all crowdfunding campaigns don't reach their target, right? And so the real thing there is if you have a strong community, a community that's behind you, crowdfunding is a really, really good thing that you should potentially look at as a mix or alternative for ways that you could be funding or financing your business.
Okay, so that's pretty helpful to know. If anybody is interested in crowdfunding, there are a couple platforms that people typically use. We have a discount with one of them, who's one of our partners, that's called WeFunder. So I just dropped that link in there. It basically saves you 12.5% off their fees, which, hey, like every little bit helps. But that was something I didn't understand before. That, yeah, I think you're totally right. Like when you go on there, you don't just get money from their community. Like, hey, I'm putting it up for sale, like on eBay, and the people will buy it. They're like, great, okay, we will set this up for
No,
you. Now go find people who want it.
you got to ring for dollars, right? It is quite literally, you'll be up there, but like you got to, and that's the thing. Part of the pitch from a crowdfunding perspective is that, hey, you know, we're going to drive ROI for this. And the reality is that 9 times out of 10, it's up to you to drive those potential investors or backers.
Yeah, and I think, someone asked what was the pre-sales one. You said Kickfurther, but I think maybe it's
Yeah,
Kickstarter.
Kickstarter. Yeah, not
Kickstarter, right?
Kickstarter.
Okay, Kickfurther, another lending
Kickstarter is a
platform.
lender.
Yeah. Okay, cool. So, yeah, makes a lot of sense. So I think let's just get into it now. I'm going to share the database, and I think it'll be really cool. I'm going to show you guys a little bit about like how it's set up and how to use it, and then pretty quickly, what I'd love to ask Daniel to do, because he's so good at it, is to actually just explain a lot of these different loan option types to us, because I think that can be a great place to start and get our baseline for those of us like me who don't know a lot about the world of financing and the options out there. Okay, so I'm sharing my screen now. Hopefully everybody can see it. Daniel, you can see it?
Yep.
Okay, great. This is the tool, guys. So everybody should have access to this. This is the Startup CPG financing database sponsored by our friends at Bags. And what you can see here, just to show you guys the navigation here, is the first thing that we have here is all of the different companies listed down on the left. So we're pretty excited to have put together what we think is a pretty comprehensive list. So we're at 66 options here now, and we'll keep adding more as we find them here. Again, just trying to get you as many options as possible. And what we pull from them, sometimes we can get them to confirm it for us directly. Sometimes we're just getting it from their website, is, okay, what is their company all about? What do they do? What kind of services specifically do they offer, in case we're only getting like some marketing language, but just like, all right, let's cut to the chase here. Like, what do you actually do? Okay, working capital, that kind of stuff. We have specifically a column here that links to the best way to get in touch with them as well, to save you all of that Googling. And then we have a bunch of columns here. So the first one is pretty cool. It's called Bags Verified. Daniel, do you mind explaining what that means for them to be Bags Verified?
Absolutely. So, we work with a large percentage of the lenders on this list, and a couple dozen others. And part of what we do at Bags is we go through and we validate, each lender, their requirements, what they typically invest in, what their minimums are. And so what we've been able to do in partnership with Startup CPG is go through and do the validation of their requirements, what products they lend, so that it really is verified as best as possible. As you know, and really the goal here is to try to save everybody time, right? Because the worst case scenario for something like this is you knock on doors that won't open, and our job is to make sure that you're knocking on the doors that potentially will open for you based off of the right use case and really what you need most.
Okay, great. And so I think you could look at it as like people you work with a lot and like, high likelihood to get kind of stuff done. Again, not verified by Startup CPG. You would not want us doing that. We wouldn't know where to begin, but by professionals at Bags who do this a lot. So that's a cool column. And any of these, you can filter up here based off the choose financing type. And select one specifically. You can even check mark just the Bags verified only ones if you want. And then you can also use any of these columns as filters. You just hit clear and then check it and it'll show you only those ones, and the same will be true. So then the last column, and then we'll go into the loan types, says minimum brand revenue and other criteria. The real thing I wanted everybody to be able to do is, as we've talked about, like a lot of questions coming in, hey, we only make 50K a month or maybe less, and we just want to know what are the options. I don't want you to have to call all of these guys and ask them. And so there are options here that even say no minimum revenue. I'm highlighting one of those here. So just to save you guys the time of digging around to everyone here, we've really put the information out here. And so the way that I would recommend using this is momentarily, Daniel will explain what all of these loan types are for us, and then figuring out like, yeah, what do you want? And then filtering, and then looking at the minimums and the companies, and then kind of starting your outreach strategy that way. So Daniel, do you want to take us away on a fun journey of explaining to like a high schooler or somebody who doesn't know anything about finance like me, just what are all these options, and how should which could be the most advantageous for early brands?
Absolutely happy to. If you wouldn't mind, I would probably just zoom in on this section in regards to the different types of loans a little bit, just so that we all those that are viewing, perfect, awesome. Scroll to the right slightly. Okay, so I'm going to start with, and I'll share. We have a slide on just these types. Daniel, it actually might even be worth putting a link out to that slide in this, explaining each, because I think that would be helpful for everybody. So I start with the, call it simplest of them all, term loans. On here, they show up as an SBA/term loan. In some cases, they are unsecured loans. In some cases, they're secured. I'll talk about security in a second. But that is your classic business loan, right? Typically, it's a loan that you repay with interest at a fixed monthly payment over a period of time. Typically, term loans are at a minimum 1 year and range from 1 year to 5 years. And then with certain products like SBA loans, they could be a 10 or 30-year loan, depending on the structure. The note here on SBA, and this is always just worth touching on, is the SBA, part of the program that they have in order to empower small businesses to get access to financing, is that the SBA has its own SBA lending programs where they give term loans to businesses through intermediaries, right? So you'll see a few of those that are listed here. The thing about SBA loans that are always worth touching on is that typically they're a lower interest rate product, which is great. The one con about SBA loans is that it does require a bit more documentation, and the time to close is anywhere between, call it 60 to 90 days, right? And so, in reality, it might be a more affordable product, but there will be more work required in order for you to get those dollars. So it's always worth something worth considering it. The thing about term loans that, in terms of use of funds to product, right? Typically, we suggest that businesses use term loan Oh, I will definitely mention personal guarantees. Thank you, David. So typically the thing about term loan products is because they are fixed rate products that in turn have a longer period of time to pay back, they're great for things like seasonality, potentially investing slightly in overhead, or things that might take longer to manifest ROI in your business. I wouldn't necessarily suggest getting a term loan, funding inventory with it, right? Like you'll see there's a lot of different types of products out there that you can use and leverage for the purposes of more shorter term use cases, but term loans are better for longer term use cases. Just to circle back to secured versus unsecured. So secured loans typically have a security on the business, meaning in the case where a business were to go, your business were to go bankrupt, they would get paid first, right? Above, usually and ahead, all the other creditors, right? Sometimes that security might also include a personal guarantee, where you in turn are personally guaranteeing that loan. So in the case where the company fails, you would also be on the hook to pay that back. And that would also potentially have an impact on your own credit if in the case where a business would go under. And so the whole thing with that is it's all about risk versus return. And in turn, if a lender can de-risk a loan by providing some sort of security, that can increase your likelihood of getting approvals.
And
So
just one question on that. You mentioned that if you like, you kind of start with SBA and term loans, which I think means you kind of like that as an option for people because it can be lower rates if they're more predictable. But then you said for things like inventory, they're better options if you're just doing that. In my mind,
yeah.
like listening to you, I'm like, well, okay, maybe part of that is because if you're just doing an inventory loan, like, yeah, you don't want to have to project out 3 years or whatever the term is. Like, you don't know how much you're going to need for that. You could do like a smaller, more kind of targeted inventory loan on that, which could help you in the long run. Is that part of it?
Absolutely. And what we've seen, some of the brands that we work with, the most success that they've had really happens when it's about finding the right use case and the right product, and especially around production runs, right? And so we look at that as a financeable event, right? An opportunity for you to secure financing, right? Specifically for that use case, right? And in turn, that inventory should have a somewhat short, probably not 12, 18 months time to be paid back, but shorter than that. And in turn, the interest that you'd pay over a term loan over a period of time would likely be more than potentially the inventory financing interest rate for a shorter period, right? And so the other thing about that as well is there in the form of inventory financing, they're securing that loan against your inventory, right? So it's also has to do with what are you using to secure that product and what are you using in turn to get approved. So it's less, hey, term loans are great, go with term loans, they're cheaper. It's more, hey, start with the use case, based off of use case, let's work back into which product makes sense. The one thing to think about from a term loan perspective, I know this is something that is probably going to be asked in a question, is profitability, right? And profitability is something to be considered across all of these loans. If you're profitable, it's easier to get financing. If you're not profitable, you still can get financing, right? Using other things like purchase order financing, like invoice factoring, right? Like equipment financing or accounts receivable financing, which we'll get to in a sec. So there are things that you can leverage, but really it's all about understanding where you're currently at and then in turn going from there.
Okay, and one more question for you,
Please.
which is, you said you might go for the specific use case. Now, if you take a question like Amy, who had said, "Hey, I need money for like UNFI
Yeah.
fees and for marketing and for inventory," does that mean like that? And that to me is kind of like growth, right? Does that mean you would already be looking at, okay, let's get an inventory one set up, let's get another one set up for this other thing, like a bunch concurrently?
So this is what goes into the complexity about building what we call a debt stack, right? And so in the case of Amy, those are really great use cases from our perspective of how you should be thinking about debt, right? Like you're taking those dollars, you're investing them into things that should manifest revenue within a certain period of time. And then what we would look at, right, is there an opportunity to specifically look at financing inventory? Are you expanding into retail? Can we leverage that? Are you profitable? And if you're profitable, let's think about a term loan. Um, um, but I think it really, really, really does depend on the business, the use case, the type of funds, and then the potential lender. Because I think the one thing that you'll find, especially when you look at some of the requirements on the right side, and it's not right, you can see day zero doesn't have a minimum brand requirement. We find that a lot of lenders have a bit of what would be perceived as a revenue floor, meaning, hey, you need to have at least $50,000 worth of annualized revenue, or 100,000 in some cases, right? So Clearco looks for $10,000 a month. And so there might be, hey, great, I've got a perfect use case for the right use of funds, but you don't fit their requirements. So it's always worth looking at the requirements as well.
Okay, great. And quick plug for Daniel and his team. At the top of this database, I just hid the kind of ugly beginning rows and disclaimer and everything, but you can actually click a button up at the top that says book a call with Bags, and Daniel and his team will do this for you one-on-one, so they can like understand those requirements better and give you some more personalized advice. And that's really what they're there to do, basically, is just to kind of like guide you through that process. Okay.
All right,
So
let's move on. We're going to go into a couple simple things and a couple more complex things. So lines of credit, think of them like a term loan that you can tap into at any given time. Very, very similar to how you would think about a credit card, but typically lines of credit are the number one type of product that businesses come to us and say they want. They're like, hey, listen, I want $100,000 line of credit. And I'm like, I want you to have $100,000 line of credit. But the things about lines of credit is that there aren't as many lenders who are willing to offer them. One, because if you think about it, they need to lock up that cash for you to draw down at any given time, meaning they can't go lend it to someone else, right? So from an expectation perspective, I'll talk about the difference between a line of credit and a credit card in a second. Typically, just to touch on it, lines of credit are often a lot cheaper than a credit card. One. Two, when you draw down on a line of credit, the ceiling is usually a lot higher than a credit card. And then three, so I touched on rate, I touched on ceiling, and time to repay is usually pretty fixed, meaning, you can sit in a credit card and sort of hold on to that and pay that interest down over time. Typically with a line of credit, it comes with a term length that you would have to repay that money back in. Right. So it kicks off a term loan as soon as you draw down on it. Okay. That's a line of credit. I'm going to move on to, let's see what we've got next here.
Just to, I know like the biggest actually challenge with this database was trying to get a rough alignment on the columns even to have in here, because people use them so different ways. But line of credit, that's part of one of these columns, or it's summarized?
Yeah. So typically that would be included, like in terms of how we've broken it down here, that's included within the term loan structure.
Okay,
but I would always, whenever someone's going through the database, I would read the services. I would see which boxes are ticked off in regards to products, and then I would also look at the minimum requirements.
Very good.
Right. So that'll give you the best view and understanding of what are sort of the spectrum of products that someone may or may not offer. Okay.
Very good.
Equipment financing, someone who is lending you money to finance the purchase of equipment, right? So if you are potentially manufacturing your own products and you need some sort of new machinery, great, equipment financing is a really, really good way for you not to have to sink $20,000 into a new machine and finance that over a period of time. And in that case, they use the actual equipment as security. So that loan is secured against the equipment. Similar to a car loan, right? Okay, now we're going to get into some of the fancier, what will be perceived products. And there's one that isn't here, and there's a reason why. So I'll leave that to the end. They're called merchant cash advances. There's a reason why they're not listed, and there's a reason why we don't have them. But for the next things, okay, so all right, deep breath. There's so much in this. Okay, so you've got purchase order, accounts receivable, inventory, and factoring, right? And what I'm going to do is I'm going to try to break this down in terms of bundling. Essentially, when you have a contract in the form of an invoice, accounts receivable, or purchase orders, right? Invoice, accounts receivable, and purchase order financing is when someone gives you a loan against one of those three things. Right? So they'll say, hey, you have a purchase order for $100,000. I'll loan you $90,000. And then depending on how long it takes for that retailer to pay that purchase order, you pay interest on that over time. And typically they are priced at anywhere between a weekly or monthly interest rate. So the thing about when you're financing receivables is that they are, if you were to look at them over the course of a year and compared to term loans, they are more expensive over a period of time, right? But the other thing to think about is that typically when you are just financing a purchase order, and one of the big things that we do at Bags is we help put together a debt calculator so that you really understand the implications of that interest rate on, your margin for that PO. Is that you're going to lose some percentage of your margin. And that could be 2%, that could be 3%, that could be 5%, that could in some cases be 7%. And that is really determined by the length in which that purchase order gets paid. And so it's always important to understand, right, and try to calculate, and we can help with that. But there's some also really, really great free tools online in terms of debt calculators that can help you understand, right, the total cost of capital for you, depending on when that invoice is paid or that accounts receivable is paid or that purchase order is paid. And just to level set expectations, typically lenders will not finance more than, in quotes, 90% of that invoice, that accounts receivable, or that purchase order value, right? So they'll only give you 90 cents so that in the case where it takes a really long time, you're not going into the red because of the interest rate on that. It's a way for them to minimize their risk.
So just to clarify the difference, purchase order, okay, you get a purchase, like Walmart takes you, hooray, and you get a big PO. Okay, that's something you could potentially go and try to finance. And then like invoice, okay, you have actually sent an invoice to a distributor, KeHE Unify, because they have 90-day payment terms, something like that, and you want to finance that. I imagine maybe the invoice rate is a little bit better than a purchase order since you've already
depends, right? Like the beautiful thing, and typically invoice financing and accounts receivable financing are very, very closely linked. Like you'll see some language on the left side where people will say invoice financing versus accounts receivable financing. Very, very similar, right? Like almost exactly the same, but very, very similar. But purchase orders, the thing about POs is that the thing they actually consider is the retailer. Who's the retailer? Who's giving you that PO? So what they're really doing is they're lending to, let's call Walmart, right? They're saying, hey, I know Walmart's going to pay their bills, so I'll give you a loan against that, right? And so in some cases, Daniel, like purchase order interest, like the rate someone pay on purchase order financing might be less than than invoice or accounts receivable, because it all depends on who's paying that bill at the end of the day.
Okay.
Is that person really going to pay?
Now, but you could get like an AR loan that is not actually an invoice if you just are owed a bunch of stuff from different people potentially, like an aggregation of like, look, I'm owed all this money. I'm stuck in this capital cycle, working capital. I just need the money, but it's not about a specific invoice. But then you could actually also go for a specific invoice. Maybe in that case, they would take into account who's supposed to pay it. Okay, that's helpful. Now I see a little bit of the differences.
And typically they always look at, right, like how much potential receivables. And there are some lenders will say, hey, I don't care if you've got, $200,000 worth of $5,000, invoices. All right, like I want all of them, right? And I'll just bundle it to one and we'll go do a deal. In other cases, they'll say, no, I don't want all that work. I just want, the big PO. And so that's something that lenders always think about and look at is and really, and one thing worth noting, and this is something that people often, I didn't realize, honestly, before we even got into this business, is that, and I want to say this in the right way, like most of these businesses have humans who are doing the lending, right? They have software to understand and underwrite, but like a lot of it is relationship based, not in the sense that, hey, if you have a relationship with me, I'm going to give you a loan or not, but more so in the sense that like how you run your own process with that lender will give them more confidence in your business versus not, right? And so like it is in that sense, relationships are important. How you present yourself is important. And so it's always something worth considering. Okay. Now I'm going to migrate over to factoring, which is one that like I think probably will like shivers will go down a few people's spines just by hearing the word. um, and to be clear, like within all of these categories, not with lenders that we have here, you can find predatory actors, right? So it's always important to understand not just the product, but who the lender is, what the interest rate is, and how you can calculate, your ability to pay that back. So just to be clear. And so when you think about factoring, people often say, that is immediately predatory. And in our case, to be honest, what we found is that there are a lot of incredibly good players who are doing factoring in an equitable way, right? And what factoring means is that rather than you getting a loan against your accounts receivable or purchase order, they're actually buying that accounts receivable from you, right? Which means they actually are the ones who are going to get paid. And so they essentially say, hey, I'm going to give you 85, 90, 92 cents in the dollar for that potential accounts receivable, right? And you get that, I get whatever they pay me whenever they do, right? Mixed in with some fees in there. Don't forget the fees, right? And so the thing about factoring, and this is just really a balancing act, is, it's about, and we've had businesses who've got accounts receivable or purchase orders, and they're like, I've got an offer for factoring and I've got an offer for financing. And the real reality is it's all about breaking down the math in regards to how that affects your gross margins on that specific accounts receivable or purchase order, right? And so understanding and calculating, hey, this is factoring. I'm going to give them X, they're going to give me Y. And like, this is how much margin I lose versus invoice has a 20 day period, 100, sorry, the purchase order has a 120 day payment period. Great. Like, awesome. 120 days versus the margin that I'm going to lose by selling this up front. Right. And so in some cases, I like, to be honest, we've had businesses where it's completely comparable, but in some cases, one will be cheaper and the other will be better. In other cases, other will be cheaper and the other will be better.
It's kind of funny. I would it makes me think of watching like a mafia movie where like you owe someone money and then like a guy from the mafia shows up. He's like, "Hey, like now you owe that money to me. I bought your debt." And you're like, "Oh, okay. Well, now if I don't pay it, he's gonna break my knee. So I'm really gonna pay it instead of like ducking my friend who I owed money to." And so I'm like, "Great, okay. If that's like the business version of this, they would take the loan. They would say, okay, yeah, now that's you owe it to us now because one, maybe they have more confidence that they're actually going to get the money if the money goes right to them instead of whatever else you might divert it to. And two, because they think they're really good at following up on actually getting paid on things. They probably have a pretty good business process for that. And so, like, for that reason, maybe it could actually be a better rate in some instances than the invoice financing. Or if it was like a mafia movie, you'd be like, all right, like, yeah, I'll take pennies on the dollar. You just go get it done. Right. So I guess it could go either way. And like you're saying, you got to look at the math.
You got to really look at the math. We're about to release our free calculator shortly, so that'll be up on our site, and we'll make sure that it gets pushed out in the community. It's really about getting to that calculation and understanding it. And then again, if you have any questions, like our team is available. This is what we do all day long. But again, it's all about the math and how it affects your revenue, right? Because at the end of the day, right, it's about forwarding that cash flow, but what does that really mean to you, right? How does that affect your gross margins? And then in turn, by having that cash flow up front, how are you ensuring that you're using those dollars, right, to continue to grow the business? That's really the thing. It's all about like investing in revenue and growth, securing capital, reinvesting in revenue, driving more revenue, securing, and that's the flywheel that we see over time. One note that I want to make sure that we finish on, and of course we can leave room for some questions. What we often find is that, the lender that will loan you your first $20,000 isn't necessarily the same lender that'll loan you the next $200,000, right? Hence why a resource like this is so essential. And so ensure that whenever you're having a conversation with a lender, kind of run it like a process, right? Like run it like you'd have an investment or VC conversation. Like, hey, like What's your typical loan size and range? Typically, how long does your process last? What's your typical time to funds? Are there typically any covenants? Do you ask for personal guarantees? Ask those questions. It will allow you to get more clarity on what to expect. Because the worst case is when you have a conversation with someone, they're like, sounds great. And then it's, 2 months later, and you thought it would be a 14-day process. And now you spend a lot of time, and that's wouldn't necessarily have happened. So ask the questions up front.
All right. And then two, I just want to make sure we check off. So okay, inventory. Then I know we kind of put in a
Oh, we
similar
didn't.
bucket.
Yeah. So I guess we missed that last one. Apologies. So
Inventory and then venture debt, if we can end on that one.
absolutely. So inventory financing is financing against the purchase of inventory. In some cases, you can get inventory financing after, which is technically transitions to asset-backed lending, right? So they're lending against your asset, but typically someone is giving you a loan. Inventory financing is someone giving you a loan to go purchase inventory, right? And there are a couple players on here who do it at an earlier stage, and then a larger amount who do it a little bit as you get bigger.
And there are some on here that say like, revenue run rate of 10 million plus. Okay, probably not relevant for you guys, so you can like ignore a lot of those. But we do want to have the most comprehensive database out there, so the stuff is in here.
Yep.
Yeah, erring on the side of inclusion for all of these ones.
And erring on the side of range, like I think that's really the big thing here is that your capital needs, like who you should get dollars from, will change over time. So it's all about having that flexibility in that range. And then the last one, venture debt. Venture debt is typically, it's not something that we're seeing as often within the CPG space currently. There are some who do it, so it's always worth touching on. One of the biggest venture debt providers was SVB back in the day. And essentially you're giving out a loan against equity in your business, right? Typically venture debt doesn't really happen unless you raise a pretty significant amount of venture. So it's always something that's worth considering. And it's a way for them to secure, and typically it also comes with pretty stringent covenants. Yes,
That's the one where like there were a couple of those like food tech companies. You're like, how are they still around? I know they can't raise any more money. They've been on like running on fumes for like years. I heard that's all venture debt.
Oh yeah, running on fumes, and a lot of those venture debt providers were hedge funds at that time,
Mm-hmm.
right? And so they're saying, hey, great, like I'll give you a loan, but like here are all the covenants, here are the numbers that you need to hit, and if you don't, I'm taking the business, right? And so yeah, venture debt still is out there, but typically like we, at least from back perspective, we don't do much of venture debt, and there aren't as many players within the CPG space doing it. The last thing I want to mention, merchant cash advance, MCAs, it's not something that's listed here. Typically it's masked and screened as, your POS system might offer you a loan, your accounting software might offer you a loan, your business service provider, another fintech platform,
Shopify, someone like that, right?
Shopify, Square, PayPal, and again, I want to caveat that with I'm not against them as businesses. They actually do some really, really great stuff from a product perspective. The thing about MCAs, though, to always consider is that fast money isn't always good money. They typically file a UCC on your business, which essentially means unsecured versus secured. It means the entirety of your business is secured, which until you pay that back, you can't go out and tap into most of the other products on this list.
Is that
right?
known as a lien?
It is a lien, a
Okay.
senior secured lien on your business. That's publicly filed. So any lender can see, hey, you've got a lien in your business.
You've got a public Joe
No.
Pesci on your
And
hands.
so even if you do pay off that loan, make sure that you follow up with Shopify or Square or PayPal or another platform and say, hey, remove the UCC if you haven't yet. And it's a public repository. You can look it up. Even if you're curious if you have one in your current business, check that. It's always worth doing.
And once you pay it off, people can still see it?
No, it's supposed to be removed once
Okay.
you pay it off. Sometimes there's a bit of a lag period between paying it off and it getting removed.
Okay. We got a couple questions come in here. One was, can you talk about asset-based lending a little more? And another was about calculators that are out there to compare terms across different debt vehicles. I know you said you had one coming out.
Yep. Let me pull up one that we send to people sometimes. Is that all? Yeah. So there's a bunch of different free calculators that exist in the market. You could like Calculator Soup's one. There's a bunch of others. You can literally go like inventory financing calculator and you'll find 50 different options. Just when you're doing it, make sure that you're actually looking at an inventory financing calculator versus term loan calculator. Those two things are structured somewhat differently. And then Bags is coming out with our own proprietary calculator specifically about calculating purchase order financing versus invoice financing versus AR financing versus AR factoring. It's complex. We're putting something out into the market. It should be hopefully really helpful to this community. Touching on asset-based lending, typically asset-based lending, if someone, for example, say there's a business I spoke to the other day, did a few $100,000 worth of revenue and they had a few $100,000 worth of inventory, and they were looking to get financing against their inventory that they have in stock. There are some lenders who will do asset-based lending on specific types of inventory. And so that's sort of the difference between that and inventory financing when you are financing the purchase of inventory before you get it, right? So as you're thinking about doing a production run, I would look into inventory financing before you go out and purchase that inventory. It's much, much harder to do asset-based lending once you have that inventory.
Good point. Okay, cool. Guys, I think we got to most of the questions that came through. I'm just kind of scanning back to see if there's anything specific. So if you were looking for the tool, Daniel dropped the link for it. You can always just kind of like go to our resources page on the Startup CPG to get access to all of our resources. We have this one. We have a bunch of other ones. We love doing this. We really are grateful for Bags being one of our partners and sponsors because this is how we get to do this kind of stuff. We're grateful also for the financing companies in the database who wanted to partner with us as well. And basically just everybody who's trying to make important tools more accessible to emerging brands. So again, if you want to follow up with Daniel and his team inside of the database, click the link that says book a call with Bags. I might even, just because we're here, I think maybe I'm just grabbing the link just to post here in the chat, just in case somebody doesn't feel like maybe they're just having a lazy day, and that's okay. Let me get
Again, all right, we're here to help. We do this all day long. Dan, to your question around debt stack, like it's all about, at least for us, term loan or line of credit to deal with seasonality, get some sort of inventory financing or inventory, and then leverage some sort of PO or AR financing as you grow into retail. Like those are the three products that we see brands that are successful start to use over time.
All right. Thank you, everybody, for joining us today. These were awesome questions and fun for me to learn alongside all of you. And thank you to Daniel. Honestly, he is the only person in the world who's ever explained this to me in a way that I understood. I regretfully am like the worst at anything around finance, but I feel like I learned a lot from him today and that I kind of get it, which is, just part of my journey. So thank you, Daniel. And, feel free to connect with him on LinkedIn as well. And
yeah. Here for it.
See you guys soon. All right. Good luck, everybody.
Have a great day.